Hi guys, this is Sebonga from Millionaires Journey. Thank you for participating in the course one more time. We are on our week 4 now, and the last video that I recorded last week was about candlesticks. It was about candlesticks chart, and then we explained which chart is best, and we explained the time frame and which time frame is best, where I said it's all about your preference. What do you prefer? What kind of a trader you are? So today we are continuing with a new topic. Today's topic is about candlestick. We are talking entirely about candlesticks, so please understand this, as it is so important, especially if you are going to be using candlesticks which are more popular. So on this video I'll be explaining what the candlestick, advantages of using candlesticks, disadvantages, and I will explain few top candlestick pattern that you can look for before you enter a trade. But about this, I will have a video specifically where I will be explaining a pattern, and then also have examples, or look for examples in the live market and show you those examples in the live market, those candlestick patterns in the market, and you can also learn how to look for them. So we'll be explaining top patterns. So let's start with our first slide. So on this one, what are candlesticks? So what are candlesticks? A candlestick chart is a style of financial chart used to describe price movement of a currency, right? So a candlestick chart is used to describe a movement of a currency. Each candlestick typically shows one specific period. Each candlestick, as you see on this picture, this candlestick shows a specific shows one specific period. A 1 month chart may show 20 trading days as 20 candlesticks. So in a monthly time frame, if you have 20 candlesticks, it means that's 20 trading days. But in a daily frame, that's in a monthly, if you have 20 candlesticks, that means it's 20 days of trading. And if you are on a weekly and you have 5 candlesticks, that means that's 5 weeks of trading, right? So that's why it says it typically shows one specific period. Candlestick chart display high, low, open and close price of a specific currency pair. Remember last week we touched a bit about this. The top or bottom of the candle body will indicate the open price, right? Depending on whether the currency moves higher or lower. So this is a candlestick. This is a candlestick, and this is the highest. This is the highest that it has been, and this is the lowest. And if it is closed like this, it means it opened here, right? It opened here, and then it pushed down to the lowest, and then it pushed up to the highest, and then it came back to close here and then opened another candle. So by looking at one candlestick, you can simply understand what the price did. You can just look at the candlestick and know exactly what the price did when it got there. So there are different kinds of candlesticks that you are going to learn about, and they all have different names. Now let's continue to the slide where I talk about the advantages and the disadvantages of this candlestick chart. So advantages of using a candlestick chart. Candlesticks determine possible price movement based on past patterns. So after learning candlestick patterns, you will just look at the pattern and you will know what it means and what might happen. It's not giving you the exact signal, but it's telling you what is likely to happen. Candlesticks are useful when trading, as they show 4 price points: open, they show open, they show close, they show high, and they show low throughout the period of time frame a trader specifies. So if you are looking at the 1 hour, you know when the candlestick opens, when it went high, when it went low, and when it closed. So it gives more details. Traders can determine instantly if the market is strengthening or weakening. So by looking at the candlesticks, you can be able to determine if the market is gaining strength or is losing strength. Say that we have this kind of candlesticks, the market is dropping, and then it starts to do this. It starts to do this. Start to do this. You can simply see that, okay, the market was, you can see that on these candlesticks, the market had power, was dropping, but when it got here, it slowly lost momentum. And now it seems like it's reversing. That's what I like about candlestick. It shows you momentum. It shows you that okay, now the buyers are coming in, or now the sellers are weak, or they are coming in. A candlestick makes you see direction easier. As I said here, traders can see direction of the market more easier. Just like this example, you can see by the momentum of these candlesticks that, okay, the market was strong, it was going down, but now it's forming something else. It's forming a new direction. You see, so it's simple. You can see that, okay, the market was dropping, it was dropping, and then now it started doing this. So you can see the direction of the market easily. And again, if it does this and now you start to see something like this, it's simple. You can see that, okay, again the market went up, but now it seems like it's weak again. It's likely to start dropping. So let's talk about the disadvantages of this chart. Candlesticks do not tell you which came first, the high or the low. So if it opened and you can see that it's complete, it doesn't tell you that, okay, this was the low came first than the high, or the high came first than the low. You just know that there's a high and there's a low. Bar chart: on the horizontal thick line to the left, on the vertical line is the open, and on the right is the close. So basically on this, what I was trying to say is that a bar chart can tell you that, okay, I opened here, I closed there, this was my low, this was my high. Candlesticks are short-term indicators that summarize sentiment, or for that particular time, is what I was showing you previously about the price movement. It shows you sentiment, it shows you for that particular time. Candlestick analysis always working in progress, because the candlesticks do not close the way they open. You are always on the lookout. You must always be active on the chart. Another issue is that there are dozens of candlestick patterns. As I said, there will be a video specific part. I will only be explaining the top 7, but there are many candlestick patterns, and I will send the book so that you can read it. So the issue is that there are many candlestick patterns, and if you try to know them all, you will have a problem, because sometimes the market can give you fake patterns and you just jump in thinking that, okay, and here's my pattern, I am going all in. You can easily learn the top 5 pattern, but trying to apply more than that becomes very hard. Yes, you can learn the top 5 patterns, but if you try to learn more than that top 5 pattern, now you'll have a problem, because there are too many candlestick patterns. So I'm sure by now you have a clear idea on what is a candlestick, and are they good or are they bad. So let's continue to the next slide. Some top patterns. So on this slide, I will be showing you some top patterns, not all of them, but I will have a video specific about this the top pattern, some top pattern. Basic candlestick patterns. Candlesticks are created by up and down movement in the price. While these price movements sometimes appear random, at other times they form patterns that traders use for analysis or trading purposes. There are many candlestick patterns. So candlesticks just move high and low, but usually they form this identifiable the patterns that you can recognize. And if you study the market, you will see that it keeps on showing you the same pattern. It shows you the same pattern, and you can just use that to your advantage. So say maybe it showed you this pattern, last week, and today you are seeing it again. You know for sure that, okay, last week it showed me this pattern and it dropped, and then even this week it's showing me this pattern and it's dropping. So why not? Why should I hesitate? Patterns are separated into bullish and bearish. Bullish pattern indicate that the price is likely to rise. Bullish pattern indicates that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. No pattern works all the time. I wrote this to emphasize the fact that in Forex you can never say that, okay, now I have this pattern, I can trade and I will never lose money. In Forex you will always lose. It will give you the exact pattern, the nice formation, everything, but losing is part of the game. You can never cram these patterns and assume that you will always be winning in the market, always be winning. No, it does not work like that. We have a bearish engulfing pattern. A bearish engulfing pattern develops in an uptrend when sellers outnumbers buyers. This action is reflected by a long red body engulf a small red body, a small green real body. The pattern indicates that sellers are back in control and the price could continue to decline. As you can see here, the price was going up and the momentum was strong, got here, but when it got here the momentum became weak, and then came this candlestick, and now it's bigger than the previous candlestick. That shows that, okay, the buyers were strong, and then when they got here they were weak and the sellers took over. So it's likely to continue like this, dropping. See, so you can use this to your advantage. You can use this pattern to your advantage. As you can see that the price is going up, now it's likely to go down. But as I said, no pattern works all the time. It means that you may see this exact formation and then the price continues pushing up, because sometimes we will lose in forex. We will never always win. Candlestick patterns represent tendency in price movement, not guarantees. You see, so it can show you that okay, last week this happened and this happened, and today you are seeing the same thing. It does not necessarily mean that it will exactly happen the way it happened, right? So this was a bearish. That means price is likely to start dropping, right? Let's look at the bullish. A bullish engulfing pattern. An engulfing pattern on the bullish side of the market that takes place when buyers outpace sellers. This reflected in the chart by a long green real body engulfs a small red real body, with bulls having established some control. The price could head higher. So it's the exact opposite of this. So this was for a sell, this is for a buy. If the price keeps goes down, then it gets weak, and you see a strong green candle out of nowhere, that means the price can start pushing to the upside, right? And then we have a bearish evening star. Bearish evening star. An evening star is a topping pattern. It is identified by the last candlestick pattern opening below the previous candlestick small real body. You see this one. The small real body can be either red or green. The last candle the last candle closes deep into the real body of the candlestick prior. The pattern shows stalling of buyers and then the sellers taking control. More selling could develop. So you see here, it went up, and then this could either be green or it can be red. It doesn't matter. If this one seems more powerful, that evening star pattern, and you can just jump in. And the exact opposite happens when you have it like this. When you have it from the sell side like this, and then you from nowhere you see this, that simply means that price can start pushing up. So this pattern can help you a lot, especially if you are using them the correct way. You are not just jumping into trade, you're waiting for a specific rule or level, because if you can see this pattern out of nowhere, they won't work. But if you can see evening star unresistant, that is a high probability sell, because it's unresistant. If you can see a bullish pattern on support, that is a high confirmation that it might go up. So you are looking at levels and candlesticks. Let's talk about the bearish harami. A bearish harami is a small real body completely inside the previous candlestick body. Completely inside, as you can see, it's inside. this is not so much a pattern to act on, but it could be one to watch. The pattern shows and the indecision on the part of buyers. If the price continues higher afterward, it may still be well with the uptrend part. A down candlestick following this pattern indicates a further slide. So if you see this pattern and it forms another candlestick that goes up, then it's fine, it's continuing. But if you see this pattern and it forms a candlestick that is going down, then you know for sure that okay, this is my chance to sell and push to the downside and collect those profits. So you must look at these patterns as they can help you a lot, especially if you know them. So these are the basic patterns, and on the other video I'll be showing you pattern, and each and every pattern we will be looking at the chart, and I will be showing you on the chart. Right, we have a bullish rami. It's the exact opposite of what I just explained. It's inside, as you can see, it's inside, and if it shows the next candlestick like this, then it's fine, it can continue to go down. But you must look out if it shows a candle like this, then that shows that okay, this market is ready to go down, to go up. Right, as you can see that it's price changing. So we'll talk about well-known candlesticks on the next part of our video, probably on tomorrow's video, and I will be posting this information in our Google Classroom, where you can just learn. So thank you for watching up to this very end. I will see you on the next lesson.